Welcome to Educational Alpha. I'm Bill Kelly, CEO of Chi Association, and your host, bringing you on-the-ground conversations with business leaders, educators, and industry colleagues from around the globe. Educational Alpha is sponsored by iCapital, the financial technology company with the mission to power the world's alternative investment marketplace. Part innovator, part educator, and part navigator of the alternatives industry, iCapital offers intuitive, scalable digital solutions that have transformed how private market and hedge fund investments are bought and sold. With iCapital, financial advisors, wealth managers, and asset managers around the world now have access to everything they need to deliver the return and diversification potential of alternatives to high net worth investors. To learn more, visit iCapital.com.
In this episode, host Bill Kelly welcomes Jeff Schafer, an expert in impact investing, to discuss the evolving landscape of alternative investments and the significant potential of Africa as an investment destination. Jeff shares his journey from traditional finance to a focus on impact investing, emphasizing the importance of aligning financial returns with social good. Listen in.
Jeff Schafer, welcome to Educational Alpha.
Well, it's great to be here.
I think you and I met in Vegas, of all places, not my favorite city per se, but attended a decent conference. And I learned a lot. I think I did a keynote with you and learned a little bit about, maybe a lot about impact investing. And you and I have collaborated on a few Chi events since then. And I think more to do there. And I do want to touch upon Africa as an investment thesis as well. I think it's a part of the world, maybe very few really understand the size and the power and the mass of people and demographics and everything else. But before we get to that, maybe sticking to the Educational Alpha playbook, maybe a quick introduction on Jeff Schafer and where you came from and how you got to where you are today.
First of all, it's always fun to come on podcasts like this and to share what I'm passionate about, which is impact investing. And so we'll get into that. But let me give you a little bit of my background. You can jump in and stop me or ask questions along the way. But real fast, I was born in California, grew up in the state of Oregon. And I only mention that because I think growing up in Oregon, I love the mountains. I love the outdoors. Although today I live in Florida, and it's actually the last place I would have probably thought I would ended up. But we've come to enjoy it here as well. Went to college. In my undergrad, I was a biblical studies major and a psychology major. I left there and went directly into the financial world. Go figure. Worked with a company called Van Camp and American Capital, which today is a mutual fund complex, an ETF complex that is owned by Invesco. I was there for a couple of years. Then I transitioned to the alternative investment space. This was well before it was in vogue. And in fact, you probably back in that day when I made the decision to come over to the alternative space would have been in 97. On paper, it looked like a crazy choice. I will tell you, I didn't make it with a lot of foresight. I just made it, and we can go into details if you want. But then I had about a 20-year career in traditional alternative investments. And what's interesting about that is, just to give you a little stat, I don't remember what the number was in 97, but I know in 2000, so I'd been in the industry for about 3 years, the industry had raised about $750 million in 2000. Fast forward to today, I think, and if I'm off by a little bit, it doesn't really matter, but I think I saw that this year, 2024, it'll be $150 billion into alternative investments. So I had a really unique opportunity to be an executive and watch the industry go from nothing to where it is today. And then I did make a strategic switch about 10 years ago to focus 100% of my time on impact investing. I am a CFP. I got an MBA from a background perspective, but I essentially learned on the job the last 27, 28 years. And I'm blessed to have been in this career so far.
Well, congrats on all of that. And then maybe we could talk about CommonGood and the transition, but some of the remarks you made about this industry, I think to be in early in anything, especially as an investor, is a very good place to be. But the moment a lot of capital is being raised, it's chasing more and more finite ideas, and the alpha gets largely arbitraged away. So there's still tremendous opportunity in the private markets, but I absolutely feel you have to work a lot harder to get it. Performance dispersion has gotten a lot wider. And I think even now, Jeff, you and I have talked about this offline. this whole democratization play and the role of the wealth manager and the RIA. It's a very complicated place to be because the client may say, well, the industry is telling me the 60-40 model is dead and I need to get myself more private equity. Private equity is not an asset class. It's a very, very complex industry. And I think many investors say, hey, look at this IRR. It's performing better than the S&P 500. Well, IRR and a time-weighted return are not even in the same food group unless the money goes in the ground and comes out all at the same time, which rarely happens. So much needs to be done in education. But that's a different kind of an impact. So back to your day job, and maybe starting with the definition, because maybe I thought this way at one point, where you think about impact is philanthropy. And it can be, but it doesn't have to be. And maybe just to overload the question, we were talking right before we flipped the microphone on about I'm at the tail end of the baby boomers. And I think my generation was, let's squeeze the investment thesis as tight as we can and just be a full-on capitalist and take every basis point that we can get. And then what I'm left over with, I can do my own investing. And I think typically that's been philanthropy. So with that, maybe you can define what impact investing means to you, what it means to this next generation, which I think is something very different, and we can take it from there.
I could pontificate on this question for an hour or two because I've thought deeply about it because I've actually lived it out. Let me answer it through a quick story. So if you think about the first 20 years of my career, and by the way, I'm a capitalist, okay? So I am a capitalist at heart. I believe in capitalism. Now, I think capitalism can go too far, which we'll touch on. But if you think about my career for the first 20 years, so the first couple years I was in public markets, and then the remaining 20 years in traditional alts, I was trained like every other advisor. Now, I was not an advisor. Obviously, I was in an asset management company. I think I've been involved with about $25 billion of transactions back in my previous company called CNL. But I was 40 at the time. I was president of CNL Securities. We would raise about $1 billion to $1.5 billion a year into alternative strategies, whether it's real estate strategies, whether it's private credit strategies, whether it's private equity. Some of it was our own stuff. Some of it we partnered with KKR, CBRE, Macquarie, the like. So I really had the pleasure of seeing the innards of this. So I ran a team of about 150 people that was compliance, due diligence, sales. So I had one foot there, but I had another foot in the asset management side of the business as well. So I would sit in on the board of all these different REITs and different investment products. So I got a really unique seat. So when I was 40, after about 20 years of that, the quick story was I had a back surgery. And at one level, it was just a back surgery. On the other hand, without making this too lengthy, it was a reset in my life. And basically, I was on this metaphorical treadmill that kept getting steeper and steeper, and I kept getting promoted and promoted. Well, I was holding on to that treadmill. I was probably never going to let go of that treadmill. My life was getting out of balance. I get hit with this back surgery and several other things. Metaphorically and literally, I woke up after my back surgery, and it's as if I saw the world differently. And it was about 5 weeks later in recovery. I'm now working, but I'm working from home. And I plugged in a DVD to an investment fund in the Southeast and it had to do with affordable housing. So getting to a practical example, what is impact investing? Understand that at the same time, I've got a team of, at that point, probably 70 salespeople. We're raising capital in traditional multifamily development and a slew of other things. So I plugged in this DVD and what hit me immediately was, and it was the CEO of this asset management group doing affordable housing, one, the competitive returns that were possible. The second thing that hit me, and this is where the impact came in, is when it had two residents of these facilities who talked about what it was like before this asset manager bought the property, infused it with capital, but equally put in new management who managed this not just from a profitability standpoint, but also cared about the residents. And here's what I heard from the residents. And these were 20-second long for both of these residents. But one of them said, they've given my dignity back. And another one said, and now I'm so excited to have people come to my house. So you put those two things together with competitive returns that frankly were better than what we were trying to do on the other side in my day job. And you saw how capital with the heart can transform people's lives. And the thesis that would ultimately get played out is if you treat people with dignity, if you do this business in a more than just profit-seeking way, there is this idea that you also then should perform financially. So I will just tell you that investment is now complete and it performed very well. Performance matched anything that I had seen before, but equally important was what it did to the residents. So impact investing is this idea of not only making money, but also putting on the table and putting into the metrics and the goals of non-financial metrics, being very specific. So in this case, it's I want to provide affordable housing. I'm making this part up, 10% less than comparable properties. We want to make sure that we are adding other wraparound services, English as a second language, food pantry, you name it. And so it's not just talk. It's a goal with a measurement and reporting on the financial side and the non-financial side. One last thing I want to say. So that's what impact investing is holistically. But one of the pieces that people forget, and frankly, this is what drove me into the space even more so, is when my wife and I started to invest, thinking about our own values, thinking about our own investment goals, and how that capital that we're investing, how it is impacting others. It's not just about me. It's not just about my wife. And so then, and this sounds a little bit goofy, especially talking in the financial world, not only did we get a return, but my wife and I got joy and some freedom investing this way. Because what you find is that when everything is just about return, you grab onto this thing and hold it so tightly. And every little thing becomes this issue you're worried about. When you understand that there's a greater cause, your heart gets drawn to it. And again, I know, Bill, it's probably weird for me to say that. I know what you do, your job, but there is this other human element that's so critical, not only how capital gets invested, but how it impacts the investee as well.
A great opening bid. And before I move to Africa, just to follow up on maybe the definitions of impact investing. And I understand everything you just said, Jeff, and not so much using this affordable housing specific example, but in general. So I think there's differences between public and private equity, and advantages and disadvantages as well. And I think patient capital in the private markets is a plus. Having a concentrated shareholder base is a plus. But every 5 to 7 years, that shareholder base turns over. And the GP and their LPs either move it into a continuation fund, and maybe that's the move now, or another strategic buyer, or sell it to a private company. So when you think about exits, and maybe it's not your job anymore because now somebody else is in charge, how important is it that it's exiting to somebody that had the same value as the prior owner? Because if you sell it to, and I'm a capitalist myself too, so I'm not ridiculing that cohort at all, but somebody that's much more focused on the bottom line. And we've seen these stories about some of these GPs, without naming any names, that have been owners of elderly housing. And I've got a son with disabilities and some of the housing for the disabled. And it's not a very good scenario. So what about the exits, and how important is that when you make one of these investments?
So it's very important, but let me preface it this way, and then I'll answer a little more specifically. Impact investing, while it is about financial and it's about the non-financial impact, I also don't want to make it this superior, infallible strategy. It's still an investment, and there's risk with that. And even though you're trying to also drive these impact measures, it doesn't mean that you always do. Now, you hope you're at least transparent. So where I'd at least start, though, is by the very question that you asked. We need more people asking that question, not just what's best for the GP, not what's just best for the investor, but also what is best for the investee, I guess, if I'm saying that right. And so there isn't a uniform answer. But here's what I would generally say. And it's interesting because everybody wants an evergreen fund. It's the holy grail, and you can argue why that is. But you can make a strong argument in the impact space that in general, the longer you hold it, the better it is from an impact perspective, because you're keeping your motives the same way when you started. So I think there are examples where in these term funds, it makes sense. There's examples when an evergreen. I personally believe in the impact space, you're going to start to see more and more evergreen funds so that you don't have the problem that you just described. You put all this time and effort in it, you sell it to somebody who doesn't care, and it goes down the drain. Now, the criticism historically has always been, if you're an asset manager, was, you just want to keep it longer so you can collect fees. And here, what we're really saying is, no, you can still argue that that's why I want to do it. But I have a very valid reason to say, no, I actually care about whatever it is. And I think that by me continuing to manage or whoever it is, that we can do it in a better way. So long story short, it's very important. You do at times have to make that decision. It's not foolproof. You can't always sell it to somebody who has the exact motives. You try to. So I would say progress, not perfection. And to me, in the traditional alt space, everybody wants, hey, how are you going to do against the market rate return? And I chuckle and go, can you explain what market rate return is anyways? That's not an exact science either, just like this is not an exact science. So hopefully I didn't skirt the issue, but you need to be cognizant of it. Ultimately, I think evergreen funds become a much more viable solution to mitigate the very question you just posed.
I think those are all fair points. And I think with the Evergreen Fund too, I think providing investors with a private market solution for their portfolio, impact or not, I think our industry has a tendency to give them what they want, which is a leaky valve in an interval fund that opens up every quarter. And not only is liquidity leaking out the door, return is as well at the same point, which is not good. And if we could say to the investor, hey, there's going to be pockets of liquidity as new investors come in, but unless you're willing to have your money locked up forever, maybe too strong of a term, but this is a long-term investment, full stop. And I think secondly, and you alluded to this as well, Jeff, is that a lot of these seasoned managers have second and third funds, and you can think about due diligence, which is so critically important, and what has their track record been. And you really need to look beyond just an IRR or creating a public market equivalent for it.
Let me add one quick comment, because I sat at the table in my previous role when this whole transition from a non-traded REIT to a daily or quarterly liquidity REIT. And look, those have been wildly successful from a capital raise perspective, and I'm not here to ding them. On the other hand, you've also seen when you try to put an illiquid asset into a liquid vehicle, you can also hit problems as well. And I don't need to mention names and whatnot. So part of this is recognizing that there are trade-offs. And with liquidity, oftentimes comes degradation of return. On the other hand, you got to provide some liquidity as well. So really, it's about setting the right expectation with the investor, with the strategy, and saying, are you okay with this? The problem is when there's a mismatch of expectation on liquidity from an investor standpoint.
I agree. So maybe a slightly, not long, but longer introduction to Africa. So as a general matter, I think capital has had over centuries a very good track record of finding the very best opportunities and vice versa. And I think that's maybe true, 80% of the time. And my percentage, not yours. But if I think about pockets where it's not, I think Africa is a very interesting thesis. And even as I thought about getting ready for this podcast, Jeff, I had to say to myself, well, let me go back and remind myself a little bit about Africa. And I just wrote down a couple of very small stats. So it's the second largest continent in the world, yet the United States could fit in just the Sahara Desert inside of Africa. So it just shows the landmass. It has 18% of the world's population, 54 countries, 3,000 languages, and 30% of the remaining mineral resources are in Africa. So there is a lot going on there. And you can tell me what the demographics are like. They ain't what they are in Japan or the US. They're awesome. So there's a lot of opportunity, but I think most investors are not thinking about Africa. But I learned a little bit from you. You're pressing me hard to take a trip to sub-Saharan Africa. I'm committed to doing it. I just have to find the time to do it. But talk a little bit about, maybe I haven't gotten all the right stats, but the investment thesis and really what is an impact along the lines of a double bottom line if you think about investing in Africa.
Can I ask you a question?
Yeah.
So prior to us meeting, and you probably have a much broader mindset than honestly most wealth advisors just because of your job and your travel. So what are your knee-jerk reactions historically been about Africa? If you were to say, let's go invest in Africa, what would be some of your thoughts? And then I'll talk through those.
I think that it's maybe two sides of the same coin. So you think about political uncertainty in pockets of it, having agency risk, something so far away. And with so many opportunities in North America and maybe emerging parts of India and maybe China before we ran into some of the challenges there, Africa was pretty far down the list of what everybody talked about. But then having done some webinars with you folks and the Venture Capital Private Equity Association over in Africa, one of the things you learn, and it's a thesis as to what a good investor thinks about, is inefficiency is the breeding ground for alpha. And if somebody said, let me tell you about this great investment thesis in Africa, and the Blackstones and the Carlyles have been there for a decade, I'm saying, well, that sounds like expensive beta to me, perhaps, where I think that if you can get behind either yourself or with a good partner around the due diligence, and then take into consideration the emerging middle class, the demographics, the amount of mineral resources, and we need a functioning middle class around the world for economies to prosper, for GPT to grow. These are important aspects. So I don't know enough about it, but I think it's a tale of two cities, which is one, the country risk and political risk, but then those uncertainties can be where you're going to find the alpha.
I think your perceptions are very accurate from what we come across. Another aspect that I would tell you that people don't come out and say, but it becomes very clear that this is in their mind. And I don't blame any for this, but it's our experience as America. So I would tell you on average, maybe above average, most investors I talk to clearly have the political fear and that kind of stuff. But it's more about Africa as a charity, not investable. Think about it. We've been asked to give to charities to Africa for years. Nobody has said, come and invest in me. And in fact, if anything, you're like, I give to Africa because that's what they're worthy for, or whatever you want to say. Go to Africa. They hate this perspective. They don't want to be viewed as a charity case. They really challenge and say, I want to be viewed as investable. So it's an interesting paradigm that, first of all, people have to get across that Africa is not just a charity case. Now, clearly, there's wonderful charity opportunities. One of my colleagues just did a white paper called The African Century and lays out a bunch of the stuff that you just described. The demographic growth will be the largest over the next 25 years in Africa. It's one of the youngest populations in the globe. Frankly, its demographics are the best in the world. Now, that also creates some problems too, because you have such a young population. You got to make sure that you have jobs for them as well. But between the population growth, the age, where it's located, the natural resources, I'm going to be so bold as to say, if you're a fiduciary and you don't understand Africa, and if you are not considering Africa from an investment perspective, you're missing a massive amount of the mega trends on a go-forward basis. Even if you don't invest there, you should understand these mega trends because they will affect the global trade and global economy. Now, it's interesting when you talk about impact investing to most people, because most people will think impact investing is almost charity. They think that Africa, by definition, is impact. It's almost like if I were to talk about 5 of the things that we do, and I were to say affordable housing in the U.S., or if I were to say renewable energy in East Africa, the one in Africa is where people are like, oh, that's impact investing. And that's just, again, just this paradigm that you are working on the bottom end of the pyramid, which in some cases is true. But Africa has huge potential. It's not without risk. So one of your agency comments, look, after going to Africa many times, I personally would not invest in Africa if the asset manager isn't sitting in Africa and needs to be very selective of what countries they're involved in. So every manager that we talk to and work with, they all have their specific mandates. They are smart people who are doing the same analysis that we do here in the United States. So you're going to find some countries that are like, we're not going to invest in that. And there are others that they absolutely will. We fundamentally believe that there should be a risk premium to Africa. In certain cases, we think, though, that risk premium, you're actually getting overpaid for it. And when the world views it all as charity, there's a mismatch there. And so if done well, that's how you get alpha. In fact, one of the funds that I'm involved with, the whole reason the fund is even in existence is because the capital in this renewable energy space, specifically small scale renewable, there isn't enough. They can get it on the debt side. They can't get it on the equity side. So to your point, Bill, that's when you step in and you fill that gap. And that's where you, frankly, can get alpha. One other thing I'll just comment, because again, the company I was with before, we probably own $12 billion of assisted living facilities. We work with KKR. We work with CBRE, these big asset managers. Nothing wrong with them. But these funds that they put together could be $2 to $5 billion. How do you find alpha when you have that? So I am absolutely disposed, because I've lived this for the last 25 years. It's not that I wouldn't put these big asset managers, but if you think about most wealth advisors, they're going to go, I'm going to put these big asset managers because it's perceived to be safer. Well, the reality is where you have the alpha, oftentimes are these boutique little niche asset managers. which means you got to do the due diligence. But if you can find them, that's really where you can find alpha. And I think you can find strategies that have outsized impact returns as well.
And I'd like to get your thoughts, Jeff, on who the LP investor RIA is. And Cerulli and many others write about this, and they talk about this massive wealth transfer, which I think is approaching $100 trillion. And by the time that hits its velocity from the baby boomer generation down, it's going to be $5 trillion a year. And if I'm the RIA and I've been focused on one client, which is the male of the household, I think they have a major blind spot. First off, the wife outlives the husband or the woman outlives the man in a relationship. And then I see with my kids, and you've got kids who are grown adults too, they've got their own views on investing. And they're not better or worse. In many respects, I think they might be better, which they want to have their views about making life better and investing aligned, as opposed to, I think my generation was, let's get a nice return and invest it as a second step. So I think that the demographic of the people that are interested in investing on an impact basis anywhere in the world, but maybe more specifically in Africa, are probably either enlightened people my age or the younger generation, these RIAs. And maybe we're just starting to see the tip of that spear where more and more money is going to be moving in this direction. So there might be, at least part of this question and answer, there might be a business imperative for the US-based RIA to be thinking about opportunities like this.
So I'll give you a little anecdote. When I left as president of this previous company 10 years ago and told everybody I'm going to go do impact investing, they looked at me like I was crazy. And at one level, I struggled with, am I crazy? Because the bet I made is that the people will bring their values into investing. 10 years to today, because I've been in this now, it is not the same discussion. It is way more of the norm to at least even start having this discussion. And what I have seen is, what does every advisor want? They want large clients. Some of the largest, most wealthy clients, this right here is the angle at which they want to be addressed, because it's a legacy issue for the patriarch, not only for typically the surviving spouse, but then also for the next generation. I've been in multiple conversations with huge families where the advisor, they can't go in and talk about ETFs and let's put someone in the S&P and whatever. It's meeting these deeper needs and desires. And so it's funny, the stat that I have in my head is 80 trillion and it keeps getting updated. So maybe it's 80, 100 trillion that's going to be transferring. And you nailed it. Women, when asked, 80+% wouldn't put their values in their investment if they could. And then for the next generation, it's over 80%. The problem is, and I'm not trying to be critical of the wealth advisor, but that's the linchpin. And there's reasons for that. It's not their fault. Part of this structuring and stuff needs to get right. But I've seen the stats that most advisors aren't talking about this. The interesting part is the advisors who are, to your point, I think they're set up for a massive wave of capital to come their way. And I have seen point blank across the country where the next generation starts to inherit the money. And because that advisor cannot address that concern, they are leaving. And ironically, they're leaving more for independent RIAs today because a lot of these large asset managers or firms, they talk about having these options, but candidly, there aren't many $1 billion, $2 billion funds. So they can't put it into their system because they're overwhelming. So there really is an advantage to some of these independent firms who can do their own research and be nimble to really take market share from the big shops.
I agree. So maybe a finishing point in terms of pools of capital. I don't know how big these DAFs are, donor advisor funds, but again, I think about probably a lot of them were started by my generation. And I think the thought was you can maximize your charitable deductions in 1 year, get the money out of your estate, and then it can grow tax-free off your balance sheet, and you can have some say in directing those assets inside of the DAF. But I think the thought was philanthropic. Give money to the local museum or a special needs case in the situation of my son Max. But the power and velocity of that money, if you think about impact, could be deployed in a very, very different way. And I don't know if that was part of the initial design of DAFs or not, but I don't know, Jeff, if you have a window into how big they might be and how important that pool of capital is to maybe jumpstarting may not be the right word, but continuing to fuel what I think could be a very interesting investment thesis.
So I'm definitely familiar with DAFs. I have a couple DAFs myself. We actually do due diligence for a $8 to $9 billion DAF to put impact funds into the DAF so that the donors can invest it in those investments prior to them ultimately gifting it to whatever charity they choose. Boy, we could talk a lot about this. First of all, I think DAFs are going to be around. I don't think this impacts DAFs. The big opportunity is a couple things. Number one, these DAFs are trying to figure out, and there are certain DAFs who have figured it out, is how do we actually align that capital inside of a DAF before it's gifted 5, 10, 20 years down the road. The challenge with it is impact investing is so personal. So it is hard for these large DAFs to put together the solution set when they're so individualized. So I think that over time, there'll be some things that happen there. I know the DAF world is trying to figure it out. I'm a part of it in one of these DAFs, and we're actually seeing more and more momentum. So I do think that'll be the case. The other thing I would say, if I was a wealth advisor, I think what's going to happen is you're going to have to address a client. And to some degree, the world already does this, but even to the next level. And a lot of wealth advisors, the investments are over here. Maybe they do some legacy planning, but they're not really doing a lot with the charitable and stuff. Going forward, I know these large families, they have certain themes and issues they're concerned about, and they want to address it from all different angles. So some of it, they're going to say, I want to do it from my philanthropic buckets. Others are going to say, hey, I actually want to do it inside of my DAF as my investment. And then your others will say, look, I have all this other investment capital over here. I'm going to deploy it from that side. So it's just another tool in the toolbox. And I think, frankly, wealth advisors are going to start to need to, if they're not, address this more holistically. This DAF and non-DAF question, what it really is, take off the labels, it's investment capital or charitable capital. And I can tell you one of the trends that's happening is the charitable intent and the investment is starting to come together. So I think you're going to see an industry that changes over the next 25 years, and probably things will get invented that aren't even discussed right now. There's just such a massive desire to meld the two because I think the world has realized that you take all the wealth in the world, and I'm just going to use, they can't see my fingers, but most of the wealth is sitting in investment and businesses. The other two places it's sitting is there's a little bit in philanthropic and there's a little bit in governments. So the world now recognizes, wait, where all the money is in investments and businesses. And so there's this push to say, how do you align the majority of wealth in the global economy to not only make money and do good? So the real question becomes, what's your definition of good? What's my definition of good? And to some degree, I don't even want to get into that discussion with people because, look, as long as you're at least starting to connect with your capital, figuring out what you want to be involved in, I don't have to agree with everybody in what they're doing. At least they're trying to be purposeful about it above and beyond just eking out a return.
There's very little certainty in life as I look forward, Jeff. But I think one thing I can say with conviction is disruption. And it's going to affect every single business model. And where I was going to go is almost finishing your sentence, which is if I think about a charitable contribution to a health and human services organization that I care deeply about, they're good at what they do. But are they good at scaling the economic portion of their model? Maybe not. So maybe there are different outcomes where they are not operating separately. They're operating as one cohesive unit. I think the power of capital and people like you and I may need to help move it in that direction. But I think it's going to be very interesting to watch what happens because we're not trying to take it out of one pocket and put it into the other. We're trying to make the power and the velocity of that capital ever more powerful.
So let me give you a quick story because it illustrates it, and I'll make this short. There's a lady that I know. She has been in the nonprofit world her whole life, and she knew at 8 years old that she was called to help fight human trafficking. Let's just assume she's my age. I don't really know. Assume she's 50. Doesn't really matter. So what she realized is the very thing that you just said, and I have her on my podcast, and she said something that just hit me. She says, I finally realized that I was in the wrong skin. And it's like, what do you mean by that? She's like, look, as a nonprofit, raising money for IT and for people is the hardest thing to raise capital for. So she says, I know I had to switch over to a for-profit business model. She goes, not that my motives have changed at all, because they use technology to solve human trafficking. She goes, the only way I can scale is I have to go for a for-profit. So you have somebody there who just acknowledged to go, for me to address this need as quickly as I can do it at scale, I can't do it in the philanthropic model. So she just illustrated your point exactly.
So I'm going to have to listen to that podcast because I've been at Kaya just over 10 years. And my very first board meeting was Feb of 2013. And I said to the board, this is 6 weeks into my tenure. And I'd been to China and to Hong Kong and throughout Europe and South America and Canada, not Africa. I need to get there. But I said, I learned all these things and Kaya's brand and opportunity. But I said, I have one question for you. Why did you organize this as a non-for-profit? And I look at the sanctity of our curriculum, and that cannot be like a golfer's shirt where somebody can come in and influence what we're saying in the curriculum. But administering a global exam for thousands of candidates, that is business and it requires capital. So I think a rethink of every business model, including my own, is a good lesson to take away from this whole discussion.
And I think the reason, I'm sure we could go down many rabbit trails. Part of the inherent reason, there's some incentive alignments, but there's this fear that as soon as you're making money, that it's going to change you and it's going to take you off course. And I think that's what impact investing is trying to do. It's asking that question all the time of, are we thinking holistically about GP, the LP, and who we're investing in? And so part of it is by having transparency, having it out there, reporting on this stuff. I think it's what helps keep you on the right track. Because look, profit is not inherently bad. In fact, you need profit to grow, but it's capitalism to the extreme. When greed and fear takes over, that's what the pushback is about. So the question is how do you leverage capitalism and business and not lose the integrity and the mission of what we're talking about?
Excellent. Well, I think a great open-ended question to leave for this discussion, and maybe we can solve that if I come onto your podcast at some point. But Jeff, thanks for all you do. Great discussion. I think when we post this, we try to separate the commercial side, but maybe putting a link into one of your investment ideas in Africa might be good to see how this plays out in real time. So I did enjoy the conversation and appreciate it. Thank you.
Yeah, it was a pleasure. And I will get you on our podcast. So I'll follow up. We'll get that done. And look, the more people we have talking about these things, it's what it's going to take. And I also think, in my opinion, you don't have to kick out traditional finance. It's just, let's make some tweaks. Let's come together. That's how we're going to make a significant change here.
Amen. Thanks, Jeff.
All right. Thank you.
Thank you for listening to Educational Alpha. I'm your host, Bill Kelly. Learn more about the Kaya Association and subscribe to the show at kaya.org. That's CAIA.org. See you next time.